In today's market update, we are going to check in on the stock market that is going for its sixth straight day of gains, something that would have seemed inconceivable just 6 days ago. We're going to look at why that is and talk about much more. Let's dive into it. Let's start today by looking at the S&P 500 because we're filming on a Tuesday and the market is going for its sixth straight day of gains. This has been an incredible turnaround for the markets. And if you look at the chart, this is over the last 1 year. The markets peaked on February 19th. They then began a sell-off that picked up steam on April 3rd after the tariff announcements by Trump the night before. We did a series of videos, kind of a play-by-play of what was happening. And as we sit here in late April, the low of the markets was at the open on Monday, April 7th, something that we flagged very possibly would be the low. And it happened. We felt confident of that based on the volatility index. And again, you can go back and watch videos if you want to see our reasoning. But where we stand now, over the last week, what's really driven the markets higher has been a couple of things. But the biggest reason has been earnings season. So right now, what we're hearing from companies is their reports for how they did in the first quarter. Every quarter we get earnings season. It's very important to listen to how companies did and what their projections are for the coming quarter. And right now, companies are on track, the S&P 500, for 10.5% profits in the first quarter. That is a very strong number. And we have heard from a lot of companies across a lot of industries. In fact, I'm going to name some companies who had very good reports and their stock prices went up. United Rentals, Lockheed Martin, GE, Boeing, AbbVie, American Express, Netflix, JP Morgan, Goldman Sachs, Texas Instruments, Google, Honeywell, SoFi, and Royal Caribbean. What I want you to know is I just mentioned companies from across all industries in the market. This isn't just tech doing well, a lot of different companies. And why that's important is that if we were in a recession now or walking into one, you would not have such a wide range of companies doing so well. That is good news, but it's not just that. We also have some companies who had disappointing reports, but yet the stocks went up. D.R. Horton, which is the largest home builder, CSX, Delta, Chipotle, Tesla. A lot of those stocks have gone up significantly since they reported disappointing quarters. What that often tells you is the stock market sold off a lot of these names 30, 40, 50%, but now the market is listening and saying, you know what? These names probably went down way too much. When you get that combined with a lot of other companies beating their numbers and raising guidance, that very likely tells you that the low is in for the markets, something that we thought was very possible. This is good news. So the second item that has helped power the markets higher is that the jobs market is just not showing signs of significant weakening that some had thought it would. We get initial claims for unemployment insurance every week. This is where if anybody's been laid off and they can't immediately find a job, they go and they file for unemployment claims. This number last week came in at 222,000. We have put this up for basically 3 years in these videos because here's the thing. We know that Americans, if they have jobs and are working, they are going to spend. And given that 70% of our economy is backed by consumer spending, we watch this chart very carefully. And you can see this last week came in at 222,000. This is just not going up, meaning companies are not laying off workers. And we're going to continue to watch this carefully because if this does start to significantly tick up, then a recession is a possibility. But as you can see looking at this chart, this just isn't rising. And this has been driven our calls basically over the last 3 years of no recession. And don't forget, at the start of 2023, over 90% of economists forecast a recession. They were not right then. A lot of them started to call for a recession again this time. And so far, there's just not the signs that they are going to be right. Okay, that's one item. Now, let me put up the next chart, which is job openings. And what this came out to this morning, 7.19 million job openings here. And this has been moving down for about the last 2 years. This peaked at over 12 million job openings about a year or two into COVID. And here's the thing. So what we're seeing, if we compare this to the report we just put up, I would say, is that there are some companies who are saying, you know what, there's a lot of uncertainty now. Let's not have quite as many job openings as what we have had, but they're not yet to the point where they're saying things are really weakening. We need to lay off workers. So we're going to watch this. What I'll note is 7.19 million job openings now is more job openings than what we had basically for most of the previous 20 years. So it's lower than 12 million, but it's still a lot more job openings than we've had for most of the last 25 years. So Goldman Sachs is one of the best research firms on Wall Street. We like some of their releases that they put out. And what we have today is they put a chart up that shows the market implied recession probability by indicator. Basically says, hey, there are indicators that they closely track that generally tells them when the economy is in a recession now or if it's going into one. This chart, we're going to start on the bottom section. It shows over there being in a recession currently. And the average right now there shows 8% if you look at those indicators. And I'm not going to go into all of them. The VIX is one of those I'll point to. We've talked about the VIX a lot over the last month. It's currently showing an 11% odds that the economy is currently in a recession. So if you add all these up, the average is only 8% that we're in a recession now. Hey, if you've listened to financial media or just any political shows, you probably thought there was a much, much higher probability of a recession right now. Goldman Sachs is saying very low odds currently. And then what about a recession starting anytime in the next 1 year up above that? And the average there is 23%. And so, listen, that's higher than 8%, but that's still less than a 1 in 4 chance. And again, if you listen to financial media or political shows, you would say there is an almost 100% odds that a recession is going to be the result of all the turmoil around tariffs right now. Goldman Sachs is saying, no, that's a much lower number. One other factor we want to talk about is the technical definition for a recession is back-to-back quarters of negative GDP. That's gross domestic product, okay? But I will note that in 2022, in the first quarter and the second quarter, we had negative GDP. But we said during that year, we are not in a recession. And the official entity that declares recessions, they also said, no, that was not a recession. Why? Because when you look at the makeup of GDP, what we look carefully at is consumer spending and business spending. How is that doing? Because that's most of what powers our economy. But guess what? There's also an adjustment to GDP that looks at what we in the U.S. import from other countries minus what they import from us. That's called the trade deficit, okay? And at times when here in the U.S. we are prospering and we're buying a lot of stuff from around the globe, and maybe they are not buying much from us, we have a huge trade deficit. Well, guess what? That comes off of GDP. So right now, the Atlanta Fed, they have a GDP Now tracker that says where they think first quarter GDP is going to be. And currently, they think it is going to track to be minus 2.7%. That is a big down number. We want to see up 2, up 2.5, up 3%. Now, what I'm going to note, the next chart up is the breakdown of how they arrived at that forecast. And what you will know, consumer spending here is at 0.91%, and then non-residential fixed investment, so that is commercial real estate, property and equipment, that is at 1%. Go down a couple lines. Net exports minus 4.9%. Here's what's happening. A lot of companies are buying lots of goods right now from around the globe to try to beat these higher tariffs, okay? That number is going to come off of the GDP. So we're going to likely have a first quarter number that is negative. When you hear that, do not panic and think, oh no, there is a recession going. Because again, when we look at consumer spending and business spending, that is still up around 2%. This is something very similar to quarter one and quarter two of 2022. That we didn't go into recession then. And again, we don't think it's likely to be one now, even if you get a negative GDP number in the first quarter. All right, now time for rapid fire, where I go through some additional charts I think you need to know about. And we're going to start off with something called the Zweig Breath Thrust. And if you didn't have that on your bingo card for today, I didn't either, but here it is. I want to talk about it with you. Basically, there is a guy named Marty Zweig who came up with this and noticed this phenomenon happen. And what this is basically a reversal of where the market goes from extreme selling to extreme buying in a 10-day period of time. And so when this has occurred 16 times since the year 1950, 16 times. And what I want to point out is 6 months later and a year later, the S&P 500 has been higher on every occasion, okay? So this has been a pretty big deal. And look at the average gains. 6 months later, on average, the stock market up over 16%, and 12 months later, up almost 24%. That's more than twice the average annual gains of the market. So, and this is 16 of 16. So we like to see this number. The second thing that I'll mention here is something that also looks at the fact the S&P 500 in the last week put up 3 straight days of being up more than 1.5%. Again, going back to 1950, this has happened, it looks like what, about 10 times or so here. And every occasion, the market has been higher 12 months later. You can see there on average up almost 21%, and the median is almost 22%. So both of those have happened in the last couple weeks, and both tell you on average the market's done extremely well with no occasions where it's been lower. That is good news. The next thing, you have probably heard in the last few days talk that, hey, shipments of cargo out of China has dropped a lot because of the 145% tariffs, and it's true that that has dropped. What you see here, this is the cost of shipping a container from Shanghai to Long Beach in California, and that has dropped a lot over the last few weeks, okay? But notice in blue, that is the cost of shipping from Saigon in Vietnam to Long Beach, and that has gone up a lot. Here's what is happening. A lot of companies are rerouting their items from China into Vietnam to try to get around the tariffs. So what's going to end up happening here is, yes, there may be less items on the shelves of a Home Depot or a Walmart or a Target here in 2 or 3 weeks. But it may not be as much as what is being discussed because of a lot of companies are going a different route to get those goods to the U.S., though you're not going to hear about that if they're only telling you what is happening with China. Now, the last chart here is taking a look on that same theme at going back to 1959, the U.S. consumer spending, because we've talked about the consumer drives the U.S. economy. Back in 1959, 45% of consumer spending was on services and 55% was on goods, items. Again, services is a much bigger part of our economy. Now here, you can see over the last number of decades here, it's grown from 45% to almost 70%, and goods has has dropped down to only 31%, meaning the tariffs are going to hit on goods, but most services spending is not going to have a direct impact, and sometimes no impact at all. So this is good news in the tariff discussions coming up in the coming months, is the U.S. economy is really driven by services. Now, before I get into the key takeaways, just a reminder to like and subscribe to the channel, turn on notifications so you don't miss a post. Listen, these last couple weeks have been very volatile, and we put out content to keep our clients updated on the markets and what we were doing, and that was very important. We said that Monday, April 7th low was very likely the low for the markets, and it's been a couple weeks, and the odds that it was the low have only gone up. Okay, for today's video, a couple of the takeaways. Number one, the last 6 days, the S&P 500, it has a nice rally. That is a surprise to some of the analysts who, when the markets were dropping, thought there was going to be a much bigger sell-off. We were not in that camp, and so far, again, it is looking like we were right there. The second takeaway, the odds of a recession here are still looking very low, and that's whether we look at the jobs market, whether we look at the Goldman Sachs numbers that we showed you just a few minutes ago, but especially from the earnings reports and guidance from companies themselves. And again, we've only heard from about 40% of companies. I'm going to be continuing to listen every day to 6, 8, 10 reports to make sure that that continues to be the theme. But so far, good news there. And then lastly, we here are still looking for buying opportunities for clients, because listen, even if the market goes up, there are some really quality companies that have been left behind, so we can continue to find opportunities there. It's not too late. Thanks for watching, and take care. Thanks for watching the video, and listen, if you are new to Centera Capital, you can go to our website, centeracapital.com, and listen, it is important, if your advisor has not been holding your hand through these very volatile markets, you need to give us a call. We have a 3-meeting process. We'd love to talk to you. YouTube's got another video about us if you want to learn more. Thanks for watching, and take care.